The Indian real estate industry is most definitely the talk of the town. Presently valued at about $470 billion, the year 2023 was a decadal high for property launches, with developers in our top 7 cities offering 680 million square feet of space, and most of it getting sold out thanks to low inventory and healthy demand. So it's massive, it's progressive, it's also complex, and in this video, I'll try to simplify it as we look at the industry structure and the key factors one should examine when evaluating a real estate company. This video borrows quite a bit from the wonderful work done by Dr. Vijay Malik, a YouTube video by Scientific Investing, and of course my own research which required reading articles, annual reports, and earnings call transcripts. Please don't expect any stock tips from this video, but I'm sure you'll learn something new, useful, and informative here. So let's begin. Now, the real estate sector comprises of residential, commercial, and industrial units. Yes, there are some larger players, but most of it is fragmented with over 25,000 active developers competing with each other, which means the pricing is very tight and the margins are pretty low. But what it also means is that the barriers to entry are extremely low, and it's perfectly possible for even a small, unorganized player with the required capital to get into the real estate development business, and key functions like construction, marketing, procurement, etc. can always be outsourced. However, the implementation of RERA, the Real Estate Regulation and Development Act of 2016, and its stringent but necessary laws are pushing out smaller developers, and the real estate industry is witnessing consolidation, which in turn benefits the larger players. Real estate as a sector is highly influenced by the macroeconomic scenarios that are outside the control of developers, so things like interest rates, GDP growth, employment levels, demonetization, and stuff like that. And it works both ways. So while on one hand there are economic downturns leading to lower demand, a drop in property values, unsold inventory, etc. But when things look up, as is the case now, one can see new and many projects being launched. Unsold inventory is at an all-time low. Consumer confidence is up. Our cities have started to transform itself into smarter cities with better infrastructure. Home loans are available at a cheaper rate and a lot more. Now, the thing with real estate cycles is that it's not a 2 to 3 year affair, but these cycles are pretty long and often last a good 7 to 8 years. For instance, the 2003 to 2011 period was one big party with real estate companies capturing as much as 12% of the Nifty 500 market capitalization. But from 2012 until 2020, the sector had a sort of a nightmare, with this market cap number falling to less than 1%, the earnings of real estate companies dropping by 80%, and new project launches down 60%. So up, down, that's how this industry works. And while we are currently up, it shouldn't surprise anyone if the sector is down again 3 to 4 years from now. But whether real estate goes up or down, it should not really bother the customers of M-Stock, a service that offers a lot at a single price point and one of the few stockbrokers in the country that have built a zero brokerage model. Yup, you heard it right, zero brokerage, which means there's free intraday, free delivery, free F&O, free mutual funds, free IPOs, and a lot more. And all of this can be yours by paying an account opening charge of just 999 rupees. Yes, just 999 for all this free stuff. And if you pay another 999, then you can also get rid of those quarterly AMC charges for the rest of your life. In fact, the M-Stock website has this detailed comparison table, and if you're someone who's into intraday, uses futures and options, does margin trading, which incredibly at M-Stock can be as low as 6.99%, then definitely check out M-Stock as it'll help you save a lot of money. But money isn't everything, right? Equally important is trust, and pleasantly M-Stock is backed by the Mirai Asset Group, which needs no introduction. It has over 8.5 lakh users. It did over 3.5 lakh crores of turnover and is estimated to have saved 145 crores in brokerage last year. So save it, trust it, compare it, and don't forget to try it. As always, the link to this platform is available in this video's description. Okay, understandably, real estate projects are highly capital intensive, requiring land acquisitions, development charges, the cost of construction, etc. To break this down, the initial part, that is the cost of acquiring land and the approvals, is generally funded by the developer, the promoter of the project, while the construction costs are funded via a combination of banks and private lenders, with the shortfall taken care by hundreds of buyers who pay installments at different stages of the construction process. That sounds easy when I say it, but believe me, these are not just high cost structures, but they are also extremely rigid, and the slightest miscalculation can lead to time and cost overruns, impacting the financial health of the project, as we saw in the case of the Amrapali Group, Unitech, JP Infratech, Supertech, and many others. So it's a very delicate business, and because a real estate developer's business comes to a halt once the project is completed and sold, he has to continually invest in land banks and keep a pipeline of projects to ensure business continuity. The large developers definitely enjoy economies of scale, which allows them to spread their administrative costs over a large number of units, and their strong market position helps them drive a better bargain with contractors, suppliers, and customers, leading to lower prices and better margin. Their size also helps them bag big contracts like building a commercial complex or large redevelopment projects that require both resources and expertise which a smaller developer might not be able to fulfill. Understandably, big players also enjoy financial flexibility with large land banks, visible cash flows, and they can also borrow against assets if the need arises, especially during downturns. Like in every industry, a strong brand is a big competitive advantage for a real estate developer. Names like DLF, Lodha, Oberoi, Prestige, Sobha, Godrej are very popular and often command a premium in the market. These developers are able to sell units at an early stage of development, and as a consequence, a significant portion of the project cost gets financed not from external funding but from customer advances, which are by far the lowest cost of funds for real estate developers, improving the project's profitability. A strong market position also means higher bargaining power. Their projects attract better customers, more investors. The big brokers are desperate to work with them, and their projects are easily approved by home loan providers. For instance, when we bought this apartment, the original allottee was an NRI who had never lived in this house, who had never seen this house, and the only reason he had invested here is because of the DLF brand, and of course the assurance that DLF would do a good job of it and would deliver the property on time. The sixth variable to consider is diversification, and one should look at it more as a risk mitigation strategy given the cyclical nature of the real estate business. So firstly, there's geographical diversification, and real estate developers present in multiple markets are more protected from things like changes in customer pattern, weather-related risks, economic slowdowns, etc. A second diversification pertains to business segments and being present in residential, commercial, which is office and retail, and also the industrial segment definitely reduces the impact of slowdowns. The third variable under diversification is the pipeline of projects, and by having them across different construction stages improves the developer's revenue and profit visibility. For instance, if most of the projects are concentrated at the early stage, then the operational risk is pretty high, and if most of them are at the near completion stage, then the continuity of revenue is at risk, making it all the more important to have a balanced set of projects. And finally, let's look at the major risks, and the first one is regulatory in nature, which comes in the form of approvals such as a change in land use, municipal corporation, the environmental ministry, fire department, PWD, and many more. Obtaining these approvals is a very time and resource consuming exercise, and with RERA's implementation since 2016, the regulatory oversight has become even more intense, which is good for consumers, but it does add an overhead on many of the smaller real estate companies. The second risk is operational. Actually, it's more of a social risk, as construction is a labor-intensive activity and developers have to pay special attention to labor relations, strikes, worker safety, union-related issues, etc. The third big risk is, of course, funding risk. We touched upon this earlier, but just to recap, real estate projects meet their financing requirements via three sources: the promoter's contribution, advances received from consumers, which is also called receivables, and of course, debt. Of these three sources, advances from customers generally take up the largest share, often covering 50 to 70% of the project cost, which means if a project's response, that is, the sales aren't good, then its financial closure comes under question, which is often followed by a liquidity crunch, cash flow mismatch, and construction delays. And finally, there is the risk of poor governance and transparency, which the real estate sector is notorious for. There have been many instances of promoters resorting to unfair and illegal means to get regulatory approvals, the lack of clear land titles, litigation, delayed or non-delivery of housing projects, diversion of funds by promoters, etc. Which essentially means no investor should skip the due diligence stage in case you're buying a property or if you are investing in a real estate stock. Okay, now that we have gone through the structural factors, let's move on to the all-important metrics and variables that will help us evaluate most real estate companies. I use the word most because the real estate sector consists of very diverse business models and understandably not everything fits everywhere. But broadly speaking, we are looking at 5 major evaluation hits. The first metric relates to the area constructed and the part of it which has been sold. Now, the area itself can be defined in terms of volume, that is the square feet, and also in terms of value, that is the square feet multiplied by the realization price. For example, in the case of Sobha Limited and particular to ongoing projects, their share of saleable area was a little over 20 million square feet, of which the company had sold 16.5, leaving it with 3.8 million square feet of area, which in value terms comes to 3,900 plus crores. Now, of course, different companies will have different numbers, but what I've generally observed is that about 20% of the saleable area is unsold due to XYZ reasons, and that can be a good benchmark when evaluating real estate companies. So basically, if the unsold area as a percentage of saleable area is 30% or more, then you have to investigate further. But if it is a lot lower, like say 15% or 10%, then we are good to go. The second metric for us to consider is the amount of money, the total amount of money collected in a given time frame as against the total area booked. Now, on a per project basis, this amount collected can be very high or very low because most projects demand money from customers depending on the stage of construction. For instance, when the foundation is laid, let's say 30% is demanded. When the building reaches the third floor, then probably another 15% is payable and so on. So every project will have a different collection setup, but if the developer you are evaluating has many projects running concurrently, then ideally they should be showing consistent collection over time, and Godrej Properties Limited is a good example of that. Another related but important parameter is to check for is whether the pending receivables from the area already sold is sufficient to meet the balance construction cost or not. So it's more of a safety measure, and taking the example of Tata Housing Development Company Limited, which is not a listed company, we see pending receivables of 949 crores as against a pending construction cost of 1,500 odd crores as of September of 2023. Together with a net debt of 2,176 crores, the company's cash flow coverage comes to just 25%, which is not definitely healthy, and it means the company is highly exposed to market risk. On the other hand, DLF Limited disclosed in its Q2 FY24 presentation that its receivables are at 12,750 crores, and against that, the balance construction costs were at 6,400 odd crores, giving it a super healthy cash flow coverage of 198%. The third metric one needs to look for when evaluating any real estate developer is the advances number on the company's balance sheet. Let me explain this. So today, many real estate companies follow a delivery-based method of accounting, which basically means even if the company receives upfront money from the buyer, it does not get converted into revenue immediately. In fact, the revenue is recognized only when the delivery of that property happens. So whatever money has been paid by the buyer goes into the balance sheet as advances and is released as and when deliveries take place. Now, when you think of the implications of this, and this is important, so number one, while the expenses are being booked for the project, the revenues aren't, which means the costs and revenues are not aligned. Secondly, if we see a high advances number, like the 1,076 crore we see in Ashiana Housing's balance sheet, it means this number at some point will eventually get booked as revenue in the company's profit and loss account. And the third implication of this scenario suggests that examining the cash flow of a real estate company might not yield significant insights. To put this together, if the advances number as a percentage of sales is on the higher side, then it's a good sign because it shows investors like us revenue visibility, which is definitely not a bad thing to have. As an example, here's what the management team at Prestige said in their recent earnings call, and I'm paraphrasing here. We have made sales of close to 32,000 crores of revenue that is still to be recognized and will come up for recognition over the next 3 years, which means 10,000 crores of top line is already assured even if we don't do any new sales. Okay, so let's move on to some growth metrics, and there are typically 3 factors to look at here. So let's go from top to bottom, and the first metric is the company's sales potential, which is often tied to the developer's existing land inventory, the further acquisition of land, and of course its joint ventures and co-development projects. For example, DLF in its latest earnings call informed that the company has identified about 32 million square feet of development parcels that offers a sales potential of 79,000 crores. The second growth factor is the launch pipeline, that is, what new projects are coming up in the future. And sticking to DLF, while the company would be closing FY24 at a sales potential of 10,500 crores, its FY25 plans are quite massive with an estimated sales potential of 32,000 crores. Of course, as we have studied in the previous section, the revenue from this will only get booked over time, but this does give us an idea of what the company has in store for the coming few years. The third number to look for is the sales booking, and pleasantly for DLF, this financial year FY24 has been a bumper year for them with 13,316 crores of new bookings until December of 2023, which is double of what they managed last year. As a matter of fact, most big developers have done well, and if you thought DLF has to be the biggest, then think again, because Prestige has booked a little over 16,000 crores in sales for the first 9 months of this financial year. And finally, there is the extent of leverage, and an important number that investors look for is the debt equity ratio, which as of now is between 0.5 to 0.7 for most companies. I use the word now because this number was a lot higher a few years back, and per a report by Anarock, the net debt of the country's top 8 realty firms was around 40,000 crores in 2019, which has since then dropped to 23,000 crores on the back of improved cash flows from strong housing sales. Of course, too much leverage is never a good thing, and ideally this debt equity number should be within the 1 mark with an interest coverage ratio of 3 or more, and that should give investors some comfort from a liquidity and also from a continuity of business standpoint. So these were 5 major heads against which different real estate companies can be evaluated, and very honestly, I thought this was the most challenging of the 10-11 different industry analysis that I've done so far on my channel. I would encourage you to use this video as a building block to understand some of the realities of this business, the terminologies, the priorities, and of course the metrics. From the looks of it, the real estate cycle in India still has about 3, 4, 5 years to go, and I'll surely come back with some company-specific deep dive either here or in my newsletter. Once again, thank you for your time. Do subscribe to my channel. Do like this video, and I'll see you very soon. Until then.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.